Derivatives. There are lots of different types of them. And we're not going to be looking at anywhere close to all of them. We're not even, with the exception of forwards, and we're going to have a look at how that works out, but we're certainly not pricing options because that's outside of our pay grade for this particular subject. So you can get, there are forwards, there are futures contracts, there are options contracts, you can get swaps on things. You can get derivatives in relation to the weather. And you sort of go out who would use them, but is it El Nino or I think it's El Nino is expected to come into effect in Australia soon, which is going to have an impact on certain industries. It has an impact. We're going into winter now. It has an adverse impact on snow conditions, and so ski fields are they need good conditions to make money off things. So certain companies really rely on the weather. You could look at a lot of sporting teams that if the weather is bad, crowds are down, and that does have a negative impact on their business. So there are reasons why potentially people would use these sort of things to minimize certain sort of risks because there are things outside of their control. So futures and forwards. For our purposes, if you're doing finance, you may not necessarily agree with this, but for our purposes, we're going to see them as pretty much one and the same thing. So a futures contract is a contract to buy or sell an agreed quantity of a particular item and at an agreed price on a specific future date. There used to be the Sydney Futures Exchange. I think it's now been rolled into the ASX, but at least at one point in time there was a futures exchange. So these are exchange traded things. So they're a lot more standardized in terms of delivery dates and what they are and the quantity of what they're dealing with. Now, we're going to just go through a really quick example of, I suppose, not one you'd commonly see now, or if you'd even see it now, but just an example, like an example of what we could mean by a futures contract, or even a forwards contract. Actually, it's probably more likely a forwards contract. So, and this actually happened. These have been in existence for a long period of time. They're not just a fancy computer-driven thing. These have been around for a long period of time, if you look at the history of them. And it was often farmers and people that grew things, that grew things that took a long period of time to mature and to get ready for market that used them. Because imagine that you're a farmer that grows sheep. Now, the time taken for that sheep I have no idea how long it takes, but let's just say that takes 6 months. That takes 6 months, and that's not a cloud. That takes 6 months for you, to start growing that sheep, or if you're planting seeds and growing crops, it takes a long period of time from you to start to get that stuff ready for market. Now, the concern that you have is right now, so at time 0, the market price, so the price in the market, where you could go down and sell it, might be, they don't sell wool by the kilo, do they? I don't know what they sell wool by. They don't even know the price of wool. Let's say it's $10 a kilo. Could be dramatically off how you sell wool. But the market price is a certain figure at this point in time. Now, your concern is that between now and when you finally get this wool, get the sheep all grown up and shorn and all readied off to market, that price is going to drop. That's because you'd like to get $10 or something nearabouts. So you may come into an agreement with someone else, so whoever you're going to sell it to, that you arrange a contract to sell them 10 kilograms of wool in 6 months at $9 a kilogram. all completely made up numbers. I don't know how they'd actually do this for wool, but they've got a contract set up with a counterparty that they are going to sell them 10 kilograms of wool in 6 months for $9 a kilogram. We then get to time 6, and the spot price, so the market price at that point in time, happens to be $7 a kilogram. And you care not one bit what about that market price is, because you have an agreement to sell with that counterparty wool for $9 a kilogram at that point in time. And so what you're going to get, now this is assuming delivery happens, which nowadays it actually doesn't, but that would mean that you would actually supply 10 kilograms of wool to the counterparty and they would provide you $90. And that has been locked in. Doesn't matter what the underlying rate, what the underlying prices are doing, you have locked in a price of $90 for those 10 kilograms. Which means if the spot price is $7 a kilogram, you've done well out of that situation. If the spot price happened to not be $7 a kilogram, but happened to be $12 a kilogram, you'd be kicking yourself a bit, because you could have just left it and you would have actually been better off, because you would have got $120, not $90. And I remember actually when I first sort of got introduced to hedging and into derivatives, and because this is in a sense almost a hedge situation, is you're not trying to always make money on it. The aim isn't to make money on it. The aim is to minimize risk, is to lock in the price that you're going to get. So 6 months out, the farmer knows as long as he supplies that 10 kilograms, which he's got to do, he's going to make $90. The other side of the agreement, they know they're going to get wool and they're going to pay $90. So that's known. There's nothing up in the air. And that's a pretty powerful tool, this understanding, knowing that it's trying to lock in a price, not necessarily make money, which is the goal of this. So that's a forward agreement. Now, because it's a contract, and we'll come back to this, it's a contract. So think of what a financial asset, financial liability are. It's a contractual arrangement. We've got a contract, we can't back out of that. Now we can take opposite positions and kind of net it out, but that's got to happen. When you move to an options contract, it's slightly different, because the option is the right, but it has no obligation attached. So it's got the right but no obligation for the options buyer to buy or sell a specified amount of an underlying instrument at a fixed price on or before a specified future date. Now, there are ways in which you can value options, and there's a number of different pricing models. If you do finance, you will come across these when you do derivative securities. And there is a vast number of inputs which go into them, and you can kind of muck around to come up with the price for them. So, and we'll talk about each of these. So keep this slide up and we'll go to the document reader. But so the actual underlying price, the exercise price, date, dividends, expected risk-free rate, and expected volatility on the underlying. So let's have a look at what all that means. So imagine instead, excuse me. So imagine instead of this situation, we're still the farmer growing the sheep, rearing the sheep. I don't think growing is quite the right word. We're that farmer, but instead of entering into a contract to sell the wool in the future, we have bought an option, and it might have cost us 25 cents. We bought an option for 25 cents to sell 10 kilograms of wool in 6 months at $9 a kilogram. So you can see there's a difference already. We've actually bought something to do it. We've paid money up front for an option. So that will be there's a financial asset that we recognize there. But we've bought something, and that gives us, and what the name suggests, it's an option to do something. So question for you guys. If the market price in 6 months, so let's just imagine we are at the final date that that option could be exercised. So 6 months' time, the option runs out at the end of the day. You can sell your wool for $9 a kilo, and the market price is $12 a kilogram. Would you sell it using the option? And so would you exercise the option, or would you just sell it in the market? You'd sell it in the market. You'd sell it in the market because you're going to get 12 bucks a kilo and make $120 selling it that way, or you're going to make $90 if you use the option. So the option at that point is effectively worthless. If there's any time to run, it's not going to be exactly zero. It might be like 1 cent or something, but it is effectively worthless because you're just going to do this. You don't, and that's the thing, it's the right but not the obligation. You don't have to do it. You don't have to use this. If the market price is $7 a kilogram, you're going to use the option, because using the option means you can get $9 a kilogram, and so you're going to make $90 rather than selling it in the market and get 70. So the option is worth something. Now, it won't be worth exactly, the difference between that is $2. So this is the exercise price. And I suppose that's the market price. So that's kind of the underlying price. So if you look at the slides, you've got underlying price. That's an important input, because if the underlying price is less than the exercise price, you'd expect that option to be worth something. Now that's not the only thing, because if this happens to be $12, but that's like 2 years before you have to use the option, there is a chance that that market price may drop below the exercise price. So it's not just the fact that this market price is above it. At this point in time, it's below it, so it'd be close to $2. The exercise price is what we've got here. The expiry date helps us with length of time before we exercise, because imagine, so that's the $9, the exercise price. Imagine where, so that's time, imagine where time 0, time 1, whatever it is. If the current price is $7, and this is where the option pricing comes in, and we're not really going to look at that, but there's a chance that that could be somewhere above it. And if it's somewhere above it, then you're not going to use it, because the market price, it pays to use the option. But there's a chance that it could be, well, not below 0, but it could be somewhere below it. And you've got to figure out the probabilities of the likelihood of you ending up above it or below it. Now, the closer you get, so if you're here and you're below it, the odds are much more likely that you're going to end up below it. So how much longer you've got to go until you get to use the option will have an effect on the value of the option. Wool doesn't have dividends, so we don't need to worry about that. The risk-free rate has an effect. Volatility of the price. If wool over history has only traveled between like $7 and $7.10 a kilogram, the odds of it ending up at $12 a kilogram is pretty much negligible. But if wool has moved from $2 a kilogram to $50 a kilogram and been really volatile, then the likelihood that you're going to end up here or below it, that becomes a little bit more likely. So it all sort of feeds into the probabilities. And none of that, I know we sort of talked about it for a little bit, none of that you actually have to calculate out. We will just tell you this option is worth X. And so that makes some of it a bit easier. But the idea is you have the option, but not the obligation to do something. Yes?
So in the first place, we have to pay 25 cents for this option.
Yeah, so you're actually buying, I mean, sometimes companies will provide, like sometimes you'll be providing options. So often management will actually be given, as part of their remuneration package, will be given options. But in this case, in these sort of situations, if you're trying to hedge a risk, you'll have to actually buy the option. So you'd actually be paying some small amount of money out up front. Yep. And that's a good point. In this situation, there is actually an upfront payment for this. Whereas in this, there's actually no payment involved. There might be deposits involved just to, just in case things go pear-shaped, but you're not actually paying for the contract up front. So, laptop. Nothing, no. Anyway. Hedge accounting recognizes the offsetting effects on profit or loss changes in the fair value of the hedging instrument and the hedged item. So what hedge accounting, what we're trying to do with it is the hedged item is you have something which moves, which changes in value based on something which you can't control. So for example, you've borrowed money from overseas, or you've bought something from overseas and you owe the supplier money in a foreign currency. That foreign currency account payable will change in value to reflect the changes in foreign currency rates. That's the hedged item. The hedging instrument is something that we use to offset those changes. And so we're going to look at how that actually happens. So the hedging instrument is a designated derivative whose fair value or cash flows are expected to offset changes in the fair value or cash flows of the designated hedged item. Now, a hedging item is an asset, liability, firm commitment, highly probable forecast transaction or net investment in a foreign operation that exposes the entity to risks of changes in fair value or future cash flows and is also designated as being hedged. So the examples we had last week around foreign currency where you've bought something from overseas and you owe the supplier, so you've got an account payable there in foreign currency. That is a liability which does expose the entity to a risk of change in fair value because the fair value of that liability will change based on foreign currency movements. So if you owe $100,000 US and currently the Aussie and the US are at parity, that liability to you is $100,000. But then if the Aussie dollar weakens against the US dollar, you might end up having to pay $120,000. So you are exposed because of a liability on your books now, you're exposed to a risk of changes in fair value. Obviously, the other side of the thing is if you are owed money in a foreign currency, for example, then it's just the reverse of that. Then obviously you want your currency weakening. I think that's right. We'll look at firm commitments and highly probable forecast transactions now. I hope no one's got, well, if you're going overseas, forecast transactions, depending on how much you've planned and how much you've actually sort of stumped up for it. As talked about last week, I'm off to New Zealand, or highly likely that I'm off to New Zealand in July. I'm uncommitted to that. Like, I'm anticipating that I'm going to go. Like, it's highly likely that I'm going to go. But if I decide, well, pretty much in the next couple of weeks that I don't want to go, it's not going to happen. So I'm uncommitted to it, but it's highly likely that it's going to happen. That is a forecast transaction. A firm commitment is where you do have a binding agreement. So it is a little bit different from a forecast transaction. So just keep those ideas in mind. And think about it from the liability perspective. When have you actually incurred something? When are you on the hook for something there? So if there's a designated hedging relationship between a hedged instrument and a hedged item, accounting for the gain or loss on the hedging instrument shall follow paragraphs 89 to 102. And there are three things that we need to be aware of. Does the hedge qualify? Secondly, the type of the hedge, and then how we actually deal with the accounting for it. In terms of qualifying, so this is paragraph 88. You could probably just put down here just paperwork, because that's what this is. It is just documentation and risk management and just putting down, just detailing what you're doing, why you're doing it, do you think it's going to work, is it working after the fact, did it work? Just lodging things in a formal way. And that's that part A. It's at the inception of the hedge, there is formal designation and documentation. It is just, it's not, yeah, let's just go out and buy, enter into some futures contracts or forwards contracts, or let's just buy an option and, yeah, look, there's something we could use to hedge this. It's actually setting everything up properly from the get-go. And that takes a fair bit of time to do. So But that's how you qualify for a hedging relationship. Now, there are two types of hedging relationships that we're going to focus on, and they're the first two. So we've got fair value hedges and cash flow hedges. And the difference becomes really apparent when you draw up timelines to see when events happen, because that is, for our purposes, the primary difference between them. It's not the only thing why they're different, but for us it will be. So for a fair value hedge, it's a hedge of the exposure to changes in fair value of a recognized asset or liability. Or if it's a firm commitment, if it's an unrecognized firm commitment. But we're going to focus on that first bit, if it's a recognized asset or liability. So if you have bought something from overseas and you have a foreign currency account payable, you have a recognized liability, and that liability will move around based on foreign currency movements. So there's a particular risk, which is a foreign exchange risk, and that could affect profit or loss, because we know as those movements in foreign currency happen, that change in account payable goes through into profit or loss. A cash flow hedge is the hedge of exposure to variability in cash flows that is attributable to a particular risk associated with a recognized asset or liability, or a highly probable forecast transaction. So in this case, we're more focusing on this second bit, so highly probable forecast transactions. It's not to say that's not something that doesn't happen, it does, but we're just going to focus on, for the purposes here, on that highly probable forecast transaction. And it could affect profit or loss. The last one we're not going to have a look at. So the last thing before we get into the second example, accounting for fair value hedges, the gain or loss from remeasuring the hedging instrument, so that is the thing that we're using to mitigate that risk, that should be measured, so that should be recognized in profit or loss. So any of those gains or losses, go into gains or loss. The gain or loss on the hedged item is recognized in profit or loss. So both sides go into profit or loss. Okay.